you can stick around
Oh yeah, absolutely. I wouldn't
much
miss
longer,
Julie.
please do. But I
I wouldn't
want
miss
to
Julie's speech.
invite Julia Coronado to join the
I'm gonna
conversation.
heckle Julia. I'm just saying. I'm gonna heckle Julia
Expect
on
nothing
your.
Now the
less from
hard
you,
questions are
Mark.
going to come. But Julia, for those who don't know, is the founder and president of Macropolicy Perspectives, which I would argue is the leading source of expertise on what's going on in the economy and its impact, in particular, on monetary policy. So, really delighted that you could be here. Julia, you've heard all this, had a chance to absorb it. I think it'd just be great to hear your perspectives, but in particular, what does all this mean for the Fed? We're expecting another big rate hike pretty soon. Does this encourage that view? Does it mean they're going to be more cautious? Does it not have any impact on their likely policy at all? Be delighted to get your feedback on that.
Yeah, so I think that there's a really interesting, I'm pretty sympathetic to a lot of the fundamental structure of the housing market that Mark laid out, and sort of the strength of the fundamental underpinnings, the differences in terms of the consumer exposure and indebtedness, and the institutional layering. I do wonder, though, we've had one of the important sources of inflation has been asset price inflation, and housing has been right alongside all the other asset price inflation. And so, I'm curious about like the distinction between, a correction and a crash. I kind of think of housing and the investor dynamic this time as, a bit more akin to the late 90s and the tech bubble than the housing bubble per se. In other words, you have these investors, they've got this business model, and I agree, Mark, it's a real business model. It started after the housing crash. It's a source of rental yield for institutional investors. It's a real thing. But, at what price, right? They were such a source of speculative momentum in the hot housing markets. And I'm living in Austin, Texas right now. So I've been watching all of this on the way up and now on the way down. So yes, I agree it's a durable business model, but, you know, you could also still see pretty big price declines just because there was so much speculative, momentum and liquidity going into this, and it can just correct hard on the way out, like a NASDAQ boom bust, which also, the NASDAQ, obviously there was a real element, a real business model there, but a layer of speculation was added on top of it that got squeezed out, and then we moved on. So I think we could see I personally think we could see a bigger decline in prices without necessarily that kind of, ripple effect or debt deleveraging dynamic like we saw in 2008 and 9. And I'd love to hear your thoughts on that. What it means for the Fed, I think actually, it could be a positive for the economy if we got a bigger correction in home prices. It would be, it would ripple into rents. Rents has been a big source of inflation in consumer price inflation. If we got a correction in home prices and a correction in rents, or at least rent growth, that could actually provide some relief, that would allow the Fed to hammer the economy less. So I think, we all know, for those of us deep in the weeds of this kind of transmission from home prices to rents to consumer price inflation, there's these long lags. But the leading indicators of home prices and these market measures of rents, if those start moving down more noticeably, then that could be, something that the Fed can lean on to say, okay, we don't necessarily need to go as far. So, I mean, right now it's going the other direction. Right now we've got home prices that, we know the high frequency measures have started to show signs of price sensitivity and discounting. That's only going to flow through to the official measures with a lag, and then an even longer lag to rents and CPI. So right now it's adding to the Fed's hawkishness. So they're in a bind. I think that the multiple sources of inflation, including the way this asset price inflation has contributed to consumer price inflation, makes their choice set very difficult. And right now they've been, they've shifted into the territory of we can't look at nuance. We can't fine tune. We've just got to crush this dynamic before it spreads and deepens even further. So in some senses, I think the faster the housing market can correct, the better for the prospects of a soft landing. In some senses, a hard landing in home prices could not necessarily do that much damage to consumers because they haven't leveraged into it. It hasn't been primarily driven by consumers. It's been primarily driven by investors. And so if investors take some losses or have to adjust, their return expectations, that I think that the economy can absorb that a lot better than what that similar home price decline would have done in 2009, 10, when consumers were leveraged into it. So, I mean, at least what I'm seeing in a very speculative market here on the ground in Austin is a rapid pace of price discounting is taking hold, which I think is great. I actually think, we've gone up about 50%, one of the highest paces of appreciation over the last 2 years. And if we went down 30%, it would be fine. You'd still have most homeowners up in value, and meanwhile it could provide a lot of relief on rent growth, on affordability, and facilitate a move back to lower mortgage rates over time.
Very interesting perspective. Thanks a lot.
Rooting for a home price crash.
Yeah, right. Well, there we go. There's certainly a headline in there somewhere. But one of the other issues with monetary policy has been the unconventional policy, the asset purchases. Do you see this? I mean, 6 months ago, there seemed to be a greater sense in some of the comments I read from the Fed about leaning more on the asset side, possibly including sales. That seems to have died down lately. This is a casual observation. How do you see this playing out between rates and asset purchases?
Yeah, so there was that dynamic. It was something that's definitely played a role in mortgage spread widening and the much more rapid rise in mortgage rates than in Treasury yields. So, I know this, Richard, from working in this space, that the threat that the Fed was holding over the market to possibly sell mortgages. And again, the rationale is there's a certain segment of the Federal Open Market Committee that views the mortgage buying as a form of credit allocation, that they, all else equal, would like to get their balance sheet to a Treasury dominated balance sheet and get rid of the mortgages as fast as possible. And we also know that because mortgage rates were so low, these mortgages were issued at such low rates and mortgage rates are so much higher, that prepayment speeds are going to be very slow. So the pace at which the Fed can allow its balance sheet to its mortgage holdings to just passively roll off is going to be extremely slow. And in fact, they've announced these caps, and that they're going to fill the roll off. The caps are the caps on the monthly pace of reduction in their balance sheet. They have a cap on treasuries, a cap on mortgages. They can fill the cap on treasuries with, short end treasuries, with bills. And so they're going to get that roll off as much as they're going to roll off right up to the cap. On the mortgage side, they won't.
That's right.
Because it's going to be very slow. So that led to that group on the Fed to they're not happy about that, so they want to think about selling mortgages. I think events overtook them in the sense, like as you noted, they've had to speed up on rate hikes because the inflation dynamic has been so rapid and so broad-based, and there's some substitution between these two tools.
Yes.
You know, the original plan was we're going to go up on rates in this kind of steady fashion, and then we're going to go, you know, we're going to take down the balance sheet in this steady fashion, and then at some point we might, you know, sell mortgages. Now they're just leaning hard on short-term rates, and it's doing a lot of work. And they've said that that's the marginal tool of policy. So at the margin, they've had to go hawkish and tighter. They're doing it with short-term rates. And that suggests, all else equal, that they're less likely to sell mortgages down the road, because we're going to get some kind of a landing, whether it's hard or it's soft. It's going to come sooner rather than later. And it'll come from their raising of interest rates. And I mean, in my view, the likelihood that they would actually contemplate selling mortgages has gone down because they're leaning so hard on short-term rates. So we've adjusted our own forecast that way. More rates and actually ending balance sheet roll off at some point next year, because the economy is going to be, you know, in a much more you know, low demand state, close to or in a recession than we had thought before they accelerated the rate hike cycle. So I think there's less likelihood. I don't know that the mortgage market has taken much consolation from this yet.
Right. No, there's any number of other issues, but I think, yeah, that fits with my perception about how the commentary has gone. I mean, the Fed's, this is still a relatively new tool, right?
Yes.
You don't have the decades of experience of what does some action mean. You've had these hiccups like the taper tantrum that unsettled the markets on the back of a single word, right? You know, so they're trying to get to that. But the thing to remember is the mortgage market has always had some support. And prior to the financial crisis, it was the GSEs. They maintained these giant portfolios that they could increase and stabilize things. They're out of that business now, and the only player in town is the Fed. So whatever
and now the Fed is out, and so the mortgage market is really flying without a net for the first time.
That's exactly right. So the Fed's figuring out what its role is in that, and you know, it'll be interesting to watch. But anyway, I think, am I right? We are just about on target here. Prakash,
thanks very much.
Bring Denise in, I guess.
Yeah, I'll bring in Denise. I just wanted, Mark, do you have a quick one minute comment on Julia's feeling that this is more like the tech bubble?
Well, you know, I don't want to disagree with Julia, because that would that's always a mistake. Always a mistake. I will definitely be wrong. I'll just make one point. The housing market is very different than the equity market, in that sellers are very reluctant to sell if they can't get the price that they think is the appropriate price. And for most people, the appropriate price is the highest Zillow price they ever saw. That is what my home is worth. I'm not giving up on that. So what happens is transactions will get crushed. The shadow price will be consistent with the decline in equity prices, but the actual price that shows up in the price indices probably will not be. So it's a very different kind of dynamic, I think, and therefore a big difference between equity and housing market, particularly in the current context.
Well, I think it's definitely a conversation to be continued. Mark, I'm hoping that you're right, that it's just a correction, because just an hour ago I found out that my son bought a house in Fairfax, Virginia. So
no.
He may have bought it, but,
isn't he listening to you, Prakash?
He was so keen to get out of our house that he didn't care. So